All right, everyone, welcome to week 21 of selling weekly lottos. Every week, I sell what's the equivalent of lottery tickets to gamblers in the stock market by using options. Every week, we got the disclaimers. I gotta say them, all right? I'm gonna make it quick. Number one, all my positions are covered. I have the cash and I have the shares, and I put those on the line so someone can win. Number two, I'm totally okay with selling the shares if I get assigned or buying the shares if I get assigned. Maybe it hurts my feelings a little bit, all right? And then number three, this is not free money, guys. This is investing. So all investing carries a risk of losses. All right, that being said, the winner this week is both of us. Again, 2 weeks in a row. That's really rare. The gambler did win one contract, which we'll talk about later, but I got $4,352 using $216,000. That's a 2.01% yield. We'll just call it 2%. All right, let's take a look at the positions. Boom! First one, Reddit 270 call. Sold 4 of those for about $930, bought them back for $16. That's about a $913 gain. Second one, Hood 140 call. Sold 5 of those for about $816. This is the one the gambler won. So I got assigned and I had to sell the 500 shares that I bought for $136. I was forced to sell them for $141.63. That's a $2,800 gain, $2,000 of which is the share sales. And then the last one, Meta 700 put. I sold that for $1,225 and bought it back for $600. That's about a $625 gain right there. All right, so let's take a look at the positions. All right, let's start one by one. All right, first one, the Reddit 270 call. Now, I did take some screenshots of the charts before all the movements happened, so there's no noise, and you can see kind of what I'm going for when I open the positions. All right, so let's look at the empty charts. All right, booyah. All right, so as you can see here, let me just, if you're new and you haven't been watching my videos, this might be the first one. None of this is technical analysis. These are all lines based on the options I sold. I'm not predicting the price based on historical trends. This is just to help visualize what's going on when I sell the option, all right? So this yellow line, that's the most important one. That's a trajectory line. That's what I call the trajectory line. That's the line the stock price has to follow in order for me to get assigned. All right, and that green line up there, that's the max gain line. That's where I will have to sell my shares, and anything past that, I'm not making any more money. The gambler's making all the money. So you can see with this Reddit chart, I actually got over 1% yield on these contracts for going 35% out of the money. That's wild. Even though there was earnings, it's still insane premium for that far out of the money. All right, so that's pretty much what I was going for. I wanted to, if it got to all-time highs, I'm okay with selling them. All right, let's see what happened. Ooh. All right, so as you can see here, in the beginning, it was following the yellow line, but then it just flattened out. And then earnings, it actually had a pop, but nowhere close to the break even. And I was able to get a double win on that one. I got the win on the contracts and my shares increased in value. So pretty happy with that result. All right, let's look at with the Hood 140 calls. All right, before anything happened, when I opened the position, look at the charts. Oh yeah. All right, so similar thing, almost the same type of thing with Reddit. I was going generally for the all-time high region. I did sell these thinking the stock was going to go up, but I thought it was going to have a hard time clearing that 140 area. All right, let's take a look at what happened. All right, All right, so this one, you can see it got totally blown out. All right, within 3 days, it was completely past my break even, and the contracts I sold for less than $200 each were worth over $1,000 each within 3 days. So imagine my surprise, right? So there was one little, you can see in the chart, there was one little 10 to 15 minute instance where I could have taken profit on my contracts, but that was the day before. It went back to 137, and it was the day before, and the contracts were still worth like 130 to 140 each. I sold them for like 160, so I could have gotten like $100 or $120 profit. So it was the day before. I was holding them the whole time, so I just thought, let's just see what happens. What's the point of taking $100 profit after holding these almost the entire time? And then the next day, it pumped again, and the options contracts went up 300% again, which is not good for me as a seller, all right? So the gambler won this one. The gambler actually made more money using $800 in investment than I made with $65,000 invested, all right? So congratulations, buddy. I'm providing a good service, all right? But really, I was kind of like punching the air with moderate force from that result. Even though I made money, I left $2,500 on the table that the gambler ran away with. It happens. All right. Look at the last one, the Meta 700 put. Now, this is reverse, so let's go ahead and check it out. All right. So this is a cash secured put. The other two were covered calls, so it's reverse. So that yellow trajectory line is going down. That's how fast the stock needs to go down. All right. And then that red line at the bottom, that's the loss line. Now, it's not really a loss because all you have to do is buy the shares if it goes below there. But I interpret it as a loss because if I have to buy the shares lower than they're worth when it expires, then the difference in that is what I would interpret as a loss. All right, so let's check out and see what happened. All right, so this one, I got super lucky. I sold it when it was around 633. The share price was 633, and it went up the next day to 733, and then it went up to 755. So the contracts went from 1,200 to 600, and I just decided to take profits. I got $600 in one day. That's good enough for me. So I just took the profits and I didn't get back in. But if I did stay in, Meta crashed after earnings, went all the way below 650. So if I held those, I would have lost $4,000. I would have lost all of the money that I made from selling covered calls for the entire month on Meta. So I was lucky to dodge that missile this week. All right, so let's talk a little bit about intrinsic and extrinsic value. Intrinsic value is the real value of the contract. That's what it's going to be worth at expiration if the stock stays at that price. Extrinsic value is anything that's not intrinsic value. So the value of the contract that's based on time left or volatility or other factors. All right. And the reason I want to talk about this is because I noticed that a lot of people are concerned when their covered calls go against them or when they're losing the covered calls. All right. So let's take my Robinhood covered call as an example because it went past the strike price this week. The way you calculate intrinsic value is you just take the price of the shares and you subtract the strike price of the contract. That's going to give you intrinsic value. And then to find the extrinsic value, it's anything that's not intrinsic value. So all you got to do is the contract value minus the intrinsic value equals the extrinsic value. All right, so 3 days after I sold those 140 calls, Robinhood's price was 147. All right, so to find the intrinsic value, you just do 147, that's the share price, minus 140, that's the strike price. It gives you $7, right? Times 100 is 700 because each contract has 100 shares. So we'll just go with 700. But the contracts were worth 1,000 that day. So 1,000 contract value minus 700 intrinsic value gives you 300 extrinsic value. All right. Now the next day, Robinhood was 145 per share, but the contracts were worth $700. All right. So 700 minus 500, all right? 500 you get by doing 145 minus 140 times 100 equals 500. That's a $200 extrinsic value. So the reason this is important is because a lot of people think as soon as the stock goes past your break even, you no longer make money. But the extrinsic value went down by 100 over a course of a day. And as the seller of the contract, I'm making that. That's unrealized gains for me. So my account value actually went up, even though the price of the shares were past the break even. All right. So every day you just hold, you're making back a little bit of extrinsic value as the price of the contract is going back to its intrinsic value at expiration. This is, you can think of it kind of like a rebate or a refund. So every day you're making a little bit of gains, even though they're past the break even. All right. Usually around a day before or the same day, that's when the extrinsic value goes to zero. All right. And that's when I'll decide to either buy to close the contracts or roll or just let them get assigned. All right. This also only really works with weekly options because there's only a few days left to get your collateral back. With monthlies or longer, it kind of hurts a little bit. All right. Also with cash secured puts, it's the same, except you're just going to take the strike price minus the share price, and that's your intrinsic value. Is just reversed. All right. So just keep in mind, even though the contracts are going past your break even, if there's some time left, you'll still make unrealized gains from losing the extrinsic value as the seller you're collecting. All right, let's talk about my benchmarks. Pull it up. Bazam! Now, a lot of stuff going on here now because we've been doing this for so long, so let's just break it down just to the metrics. All right, so I've made over $33,000 at this point in 21 weeks, and that's using an average of $132,000 per week. All right, that gives me a weekly average income of over $1,500 now, almost $1,600, and that's an average weekly yield of 1.19%. All right, that over the course of a year, if I'm able to continue this, I can make over $82,000 at an estimated annual percentage yield of 62%. All right, but so far in 21 weeks, that's a total yield of just over 25%. All right, for the fund metrics, if I can continue at this rate, my average income should be, my total income should equal my average risk in about 63 weeks. That means I get a house money account or a free money account. All right, and the profits that I'm making per week from my profits, like the profits I've already made, are making me almost $400 a week in profits. All right, that's profits from profits. And then lastly, I have sold 27 total calls, 7 of which have been assigned, and I've sold 21 unique puts, 1 of which has been assigned. The rest I've bought to close. So that's pretty much it, guys, this week. One thing I want to say is sometimes the gambler has to win, okay? Sometimes for the rest of the time we can win, all right? That's just part of the game, all right? If the gambler never had a chance to win, we would not be making any money because these contracts wouldn't have any value because no one would be buying them. The reason they have a high premium and the reason these gamblers, these speculators are buying them is because they believe they have a chance to win sometimes. So they gotta win sometimes in order for us to win the rest of the time. All right. So that's all I got to say this week. Thanks for watching again. Thanks for liking. Thanks for subscribing. Thanks for leaving comments. If you got any questions, put them in the comments and I'll try to LE5. I'll try to explain it like I'm 5 to you and just try to help you out and learn this. I think this is one of the best strategies I've ever found to make passive income. All right. Peace.